On our earnings radar, we have Equitas Small Finance Bank. The bank reported a weakish set of numbers in the second quarter. The MD and CEO, Mr. PN Vasudevan, joins us to discuss the company's last quarter performance. Hi, Mr. Vasudevan. Good morning and thanks a lot for joining in. It seems, the markets are not too impressed with the numbers that you have delivered because your return ratios have been weak for the past 2 quarters in a row. That's predominantly because of the high credit costs as slippages have remained elevated. Give us your expectations on the pain from the retail portfolio going ahead, especially the MFI and unsecured portfolio.
Yeah, good morning. In Equitas, we have 84% of our book, which is a secured book. 16% is our microfinance, which is the unsecured book. As we all know, the microfinance industry has been going through some level of stress. In fact, we have been in the microfinance market now for about 18 years. And this is the first time that I am seeing something which is really internal factors which are causing us stress in microfinance. Otherwise, it's always been traditionally external factors which have caused stress in microfinance. And this time, because it's an internal factor which is causing the stress, we are also seeing that the stress is not really limited to a geography. It's across the entire markets that we operate. And also, it's gone on for a time period which is longer than what we have ever seen in the past. So because of that, I think microfinance is going to remain at some level of stress. And if you see our own results, we have taken a 10% credit cost hit in microfinance for the first half or for 16% book. Whereas the remaining 84% of the book, the credit cost is about 1.03%, which is quite normal. And that 10% includes a one-time provision that we created of 145 crores in the second half. So if you remove that one-time provision, our normal credit cost itself would still have been somewhere in the range of 6.5% for the first half against a standard credit cost of around 2%. So 2% in microfinance will be absolutely normal, but now it's gone to about 6.5%. So that is where it is all showing up. And because we saw the pain, some more pain coming up in the next 2 quarters, we thought, why not we take an upfront provision buffer that we created so that we can have upfront as much of the pain as possible rather than keep on having it coming every quarter.
You said it. There is a serious amount of stress in the MFI portfolio. The good part is that you've upfronted all of those costs. The worry, however, is that despite all of this, there could be increased slippages going forward as well. So I just wanted your thoughts on 2 parameters in particular. One, your slippages in this quarter have been around 505 crores. This is higher by almost 31% versus the comparable period. Annualized slippage ratio also at 5.6%. And that's impacted both your gross and net NPA ratio as well. On a steady state basis for the next couple of quarters, what is the kind of credit cost guidance that you can give us along with quarterly slippages? If you could give us those numbers.
Yeah, so the gross slippage has remained elevated in the second quarter. Largely that is come out of the MFI and partly contributed by vehicle finance also. Vehicle finance, the net impact will not be much because most of the accounts which slip into NPA are recovered. And so the net impact at the NPA level is not that much. But in microfinance, the recoveries also are not as strong once they move into overdue buckets or NPA cases. The recovery is also not as strong as in the secured book, and that's where the credit cost keeps mounting up. From a guidance perspective, we really are not wanting to give a guidance on the credit cost for the second half. But that 1% that we have on the 84% of the book, traditionally the second half of the year has always been very strong, whether it is disbursement or collection. So that 1% we should see it coming down a bit on the 84% of the book. And the 6.5% normal credit cost of the microfinance, removing that one time that we made, that 6.5%, the question is when will it come to the 2%, which is our normal? If it comes, then our total credit cost will be around 1.25%, which is what we normally have. The question is whether it will come to 2% anytime soon. And we have put in a lot of efforts, both at the industry level and at our bank level. Initiatives have been rolled out in the field, trying to get more people onto the ground to spend more time with the customers, etc. As well as we have introduced a few new products and offerings for the customers. Since we are a bank, we have a wider bouquet of products to offer to try and help them come out of the over-leveraged position that they are in today. And so that 6.5% of normal credit cost that we saw in the first half even if we can reduce it to something in the range of 4% or so for the second half, I think that will still be very positive for the bank, because that 1% on that 84% will anyway come down. And this 4% coming down on microfinance would mean that our overall credit cost should be something reasonably close to normal.
Got it. Okay, all right. That's fairly explained then. Tell us about NIMs. They've contracted yet again. What is the contraction you're factoring in for the second half of the year? When do we see the NIM growth come back? And also, if you could tell us what kind of deposit growth you're factoring in?
Yeah. So the NIM is generally impacted by three factors. One is our cost of funds, second is our lending yield, and third is the NPA movement, because every time an account slips into NPA, we have to reverse the income that has been recognized on that asset. And so that has an impact on NIM. So if you look at the three components, our interest cost, if you see, has been steady over the last 2 quarters. It's around 7.5%. And we have peaked on our interest rate, so I don't think our interest rate is going to go up any further. Interest cost is not going to go up any further, assuming that steady state interest rate in the market. On the other hand, we actually tweaked our savings account balance slabs a bit in the first quarter. We tweaked it again in the third quarter in the month of October, as well as we reduced our peak interest rate on deposits from 8.5 to 8.25 in the first week of October, because of which we expect to see a marginal reduction in our interest cost over the next 2 quarters, even if interest rate in the market remains at same levels. So that is on the interest rate. The second comes on the yield. On the yield, if you see at the presentation that we have set up, our yield has actually remained at the same level as the first quarter, indicating that our lending rates are holding up, and we don't see much of an issue in terms of maintaining the yield on the book. The third component now finally we come to is the interest reversal because of extra NPA movement, which is the real problem that we have seen in the first and the second quarter, and that is what is impacting the NIM significantly. And so that we'll only be able to reverse that as and when some of the accounts get into more normal mode. So that is something that we have to just wait. But fundamentally, we don't have an issue on NIM. As and when we are able to get the stress in microfinance sorted out, then we should see the NIMs holding up and maybe moving up also.
All right, Mr. Vasudevan, we're out of time, not out of questions. So we'll, request you to join us once again for a more detailed chat on how you plan to, alleviate the situation that there is in the MFI space with your feet on the ground, etc. You're talking about getting the customers out of their over-leveraged positions. What are the measures that you are taking to ensure that that happens, and the kind of impact that that could have on your OPEX, etc. as well, is something that we'll discuss. We invite you for another conversation very soon as well. With that, take a short break, come back and get you more on the markets and a lot of stock-specific action. A lot of stocks buzzing around right now. The Nifty is still holding with gains of almost 80 points.